In this video, we're going to continue on with Chapter 7, specifically talking about short-term investments, which are also referred to as marketable securities. So marketable securities, they are mostly going to consist of things like bonds and capital stock. So investment in bonds and capital stock of other companies. So one thing that's characteristic of these short-term investments is they are readily marketable, which means a company can easily sell them to someone else and easily buy some more. So because of their marketability, because they're so easily sold and can be so easily converted into cash, they're often listed as part of current assets. But in the event that management plans to hold on to let's say some stock and bonds for longer than a year, they can decide to reclassify it as a non-current asset under non-current assets on the balance sheet. So, but for our purposes, we'll assume they are current assets, and the intent is to hold them onto them for less than a year. So let's look at what it would look like to record the purchase of some marketable securities. So if we look at Foster Corporation, they purchased a short-term investment of 4,000 shares of the Coca-Cola Company on December 1st. Foster paid $48.98 per share plus a brokerage commission of $80. So let's take a look. So we bought 4,000 shares times $48.98 per share. So we paid $195,920 plus we had to pay $80 in brokerage commissions. So the overall amount that we're having to pay is $196,000. So you don't want to forget about adding in the cost of that brokerage commission there. So the total amount, the 4,000 plus times the 48.98 plus the 80 gives us 196. So to record this purchase, you are going to debit the marketable securities account. Since it's an asset that's going up, we're going to debit marketable securities for $196,000, and we are going to credit cash for $196,000. So this is an example of taking some excess cash and investing that in a short-term investment like this. So that's what the purchase entry would look like when you initially buy some shares. Now, what happens if and when the company receives some dividends on these shares that it purchased? So here it says on December 15th, Foster Corporation receives 30 cents per share dividend on its 4,000 shares of Coca-Cola. So this is dividend revenue that needs to be recorded now, because on these 4,000 shares, Coca-Cola is going to pay Foster Company 30 cents per share in dividends. So this is the opposite perspective than what we looked at before, where we were the ones paying dividends. Now we're going to see what it looks like with a company owns stock and is actually the one receiving a dividend. Take those 4,000 shares times 30 cents. So that's $1,200 of dividends. So dividends, that's going to be received in cash. So we want to debit cash for $1,200. And we're not going to credit dividends because the account dividends refers to dividends we have declared to our stockholders. So you want to make sure you're debiting or crediting the correct account. We want to credit an account called dividend revenue for $1,200 because we are the ones receiving the dividends. It's revenue to Foster Company. So they're going to debit cash for $1,200 for the amount of cash received and then credit dividend revenue to report that amount of revenue that has actually been earned now. Now let's look at what about when we actually sell some of these stocks after I've purchased them. So I purchased 4,000 shares, but it can happen that Foster Corporation decides to sell some of those shares, and that's exactly what happened on December 18th. So Foster Corporation sells 500 shares of its Coca-Cola stock for $50.04 per share, less a $20 brokerage commission. Okay, so there's a couple of things that we want to figure out here. So let's first find what our sales proceeds are. So the sales proceeds that's just what are we getting for these shares. So we're selling 500 shares, and we're getting $50.04 for each of those 500 shares. So if we take 500 times $50.04, that's $25,020. But there's a commission fee there, so we're gonna subtract out because we don't get to keep all $25,020, so we have to pay $20 in commissions. So the overall proceeds is just $25,000. So we want to compare those sales proceeds to the cost of those shares. So cost of the shares. So we don't want to be too quick to say that these 500 shares originally cost me $48.98. Close, but remember, we ended up paying a brokerage fee on all 4,000 shares, so really it ended up working out to be a little bit more than $48.98 that we were paying per share. So initially, when we found out what we were initially paying for those shares, remember we paid $48.98 per share for each of those 4,000 shares. Let's find that first. So 4,000 times $48.98. That gave us $195,920. But then remember we had to pay a commission as well. And that was an $80 commission. So we ended up paying, remember, $196,000 for these marketable securities. So we can figure, okay, what is that actually per share? So we would simply take that $196,000, divide it by the 4,000 shares that we purchased originally, to see that actually the cost per share ended up being $49. So that's the figure that we want to use to figure out, okay, now I know what the sales proceeds are from these 500 shares that I sold now, but then what's the cost of shares sold? Okay, well, each share cost me about $49 per share, and I sold 500 shares. So we'll do 500 shares times 49. So that's $24,500 of total cost of selling these shares. So we want to compare the cost to the sales proceeds. So there's a $24,500 cost versus proceeds of selling those shares of $25,000. So now you want to figure out, is this a gain or a loss on sale of investment? Here, we received more than what we paid for those shares. We received $500 more than what we initially paid for those 500 shares. So this is really a $500 gain on sale of investment. So again, we received $25,000 from selling these 500 shares, but they only cost us $24,500 to initially acquire. So that's how we figure out what the gain or loss is here. And now we need to journalize that. So we received cash, right? Specifically $25,000 cash. So here you would debit cash for $25,000. We just sold some shares, right? So our marketable securities account needs to go down. So we would credit marketable securities for their cost, so $24,500. And then we're out of balance. So to make that balance, we would end up having to credit the account called gain on sale of investments, and that is a $500 gain. So that's how we would journalize this situation here when we're selling these shares at an amount higher than what we paid for them. Now let's look at the opposite situation when we're selling investments at a loss. So on December 18th, they sold these 500 shares of Coca-Cola stock at a gain, but then on December 27th, they sold, Foster Corporation sold an additional 2,500 shares of its Coca-Cola stock, but for $48.01 per share, less a $25 brokerage fee. So again, the first thing you want to do is find, okay, what are the sales proceeds here from selling these shares? So that's the first thing we want to do, is find the sales proceeds. Well, we sold 2,500 shares. In this case, for $48.01 on December 27th. So 2,500 shares times $48.01. That's $120,025. Okay, but then we also have to pay that $25 brokerage fee. So we're going to subtract out the commission fee or the brokerage fee of $25. So really the overall proceeds end up being $120,000 in this case. So that's the overall sales proceeds. And we want to compare that to the cost of the shares sold. Cost of shares sold. So we already figured out what the total cost per share ended up being from that initial purchase. So that's $49 per share. So these 2,500 shares that we just sold, to acquire them, we paid initially $49 per share to buy them, to purchase them, to acquire them. So let's see what the original cost is of those shares. Those shares originally cost Foster Corporation $122,500. So that's the cost of those 2,500 shares, but we only ended up receiving now $120,000 for them. So we ended up selling them for an amount less than what we actually ended up paying for them. So we want to compare the cost. So the cost here was $122,500. Compare that to the proceeds, and the proceeds are only $120,000. So if I paid $122,500 for something, but I only get $120,000 for it when I sell it, that is a loss. That is exactly a $2,500 loss on sale of investment. So to journalize this, the proceeds, that's how much my cash is going up. The cost, that's how much you want to adjust marketable securities for now that you sold some shares. And the loss in this case also needs to be journalized. So we're going to debit cash for $120,000. That's how much cash went up that's how much we overall received in cash for this sale. But then remember, we also sold these marketable securities, so we have to decrease them, credit that account to show that that account has now actually dropped, since the more shares you sell, the less shares you own. So we're going to then credit the marketable securities account for its cost. So that's $122,500. You can see we're out of balance here, and we need to make this balance. We're going to have to debit something for $2,500, and that something is an account called loss on sale of investment. So this is what it would look like when you have to journalize the sale of marketable securities, but at a loss. So now that we've recorded not only the purchase of this stock, but then subsequent sale of the stock throughout December, now when we hit December 31st, we have to adjust the marketable securities balance, adjust it to reflect the current market value of the shares that are left over. So remember, we initially purchased 4,000 shares, and then on the 18th we sold 500 shares, and on the 27th we sold another 2,500. So we currently have 1,000 shares left, and then remember, those shares initially cost us $49 each. So the balance in marketable securities as of December 31st should be $49,000. But remember, we value marketable securities at current market value. So at the end of each period, you want to, according to GAAP, to follow GAAP, you want to adjust its current balance up or down to match the current market value. So let's take a look here. So on December 31st, Foster Companies or corporations' remaining shares of Coca-Cola capital stock have a current market value of $47,000. Prior to any adjustment, the company's marketable securities account had a balance of $49,000. Remember what we just found. We have 1,000 shares left, costing us $49 each. But the current market value is only 47. So we actually have to mark the marketable securities account down to current market value. So that will involve a decrease to marketable securities in this case because market value is lower than the balance in that account. And the account that we will increase to offset that is an account called unrealized holding loss on investments, or it would be unrealized holding gain on investment. So we have marketable securities here currently with a $49,000 debit balance, but we want to get it down to 47. So the only way to do that is to credit marketable securities for $2,000. And to offset that, we will debit the unrealized holding loss on investment. So you'll debit unrealized holding loss on investment. It's a long one. Debit that for $2,000. We will credit the marketable securities account for $2,000. So after this entry, the new balance in marketable securities will be $47,000 to reflect current market value. Now, if market value was higher than the current balance, if market value was 50,000, not 47, you would flip the order of this entry. So you would instead then debit marketable securities for 1,000, and you would credit unrealized holding gain on investment in the opposite situation. Now, this is an interesting topic because although our discussion won't really, for the scope of this class, we won't really go beyond really these types of journal entries and this kind of analysis, but it's important to note that GAAP has recently changed its accounting treatment of these unrealized holding gains and losses on investments. So as far as I understand, in Connect, this is still the account name, unrealized holding loss or unrealized holding gain on investment. However, the accounting treatment of what's happening here, for example, in this situation, has changed. So prior, again, I want to reiterate, prior to the GAAP standard change, prior to this unrealized holding gains/losses account, this was considered to be an equity account that you would see listed along with capital stock, retained earnings, so on and so forth. It would have been listed as part of equity and would have affected the overall equity balance in that way. Because this is an unrealized loss in this case, because we didn't sell these 1,000 shares that are left over, right? Because they're shares that we still own. All we're recording here is how those shares that we still own, how their market value has shifted. So it's not a realized gain. The only time we have a realized gain or loss is when we actually sell shares, like with these two prior examples. This first one wasn't a realized gain. When we actually sold shares at a gain, that's a realized gain that we will be taxed on. Same with the loss. This is a realized loss because I actually sold those shares. But what we're looking at down below is how the market value of the shares that we have left has changed. And this, prior to the standard change, we treated unrealized holding losses or gains, like this unrealized loss of $2,000, just as a separate equity account. But that has since changed. So really the account name that they'll be using now, I believe in Connect they haven't yet switched this out, but in the real world, to follow GAAP, companies aren't supposed to use this unrealized holding gain or loss account anymore. And instead, they will use an account called loss on investments or gain on investments to record these end of the period adjustments to market value. Now, this seems a little bit counterintuitive or counterproductive, right? Because we just said that, well, we haven't sold these shares, so there isn't really an actualized or realized gain or loss. But this change in standards has companies now actually record, for instance, in this case, we had an unrealized holding loss, just a dip in the shares market value that we have left over. Instead, we would have to recognize this $2,000 dip in market value as an actual loss on our investment, although we didn't actually sell them. And what's the implication of that? Well, this account, first of all, it changed its name, and it's not a separate account under equity. Instead, the loss on investments, that would be considered like an expense account, and the gain on investments would be considered more like a revenue account. So the standard not only changed the kind of account that we use, but it changed which part of or which financial statements it affects. Previous to this, the unrealized holding gains or losses went on the equity portion of the balance sheet as its own account. But now, having changed the two kinds of accounts that you can use, any unrealized gains or losses due to these adjustments at the end actually affect the net income, or the overall comprehensive income rather, of the company. So if there's a loss on investment or a gain on investment due to adjusting marketable securities to market value throughout the year, you will see these items on the actual income statement under the category Other Expenses / Other Revenues. And because these are considered to be like an expense or revenue account, both of these kinds of accounts at the end of the period would end up having to be closed along with all other revenues and expenses. So when we start the new period, both of those would have blank balances or zero balances to start the new period. And I mention that because it's relevant for the homework problem that covers this. So as soon as we go into a new year, for example, the loss on investment account and the gain on investment account will be wiped clean to start the new year. So to recap, this is the general structure of recording an unrealized loss on your investment. It would be the reverse if it was an unrealized gain. Technically, to follow GAAP with the standard change, in this case, we would, instead of using an unrealized holding loss account, we would use instead the account called loss on investments. And that would be considered an expense account that impacts the overall company's net income. So it will show up on the income statement. So just keep in mind, this is really as far as it's going to go, but it's important to mention that the standard has changed. So if you were taking my class prior to this change, the unrealized holding loss or the unrealized holding gain account would still be in use, and it would be something that doesn't go on the income statement, but actually just goes on the balance sheet. But that has now since changed. So that's that for the purchase, subsequent sale, and adjustment of marketable securities to market value at the end of the period.